Ladies and gentlemen, welcome to another episode of the Resource Insider Podcast. I'm your host, Jamie Keach, and we are coming to you from the Inventa Capital Studio. Now, today on the podcast, I had Stephen Stewart, the chairman of the OR Group, a group of companies based out of Toronto, Ontario. They're looking for gold, they're looking for copper, they're looking for uranium, now they're looking for nickel, all over North America. So we get into detail on all those portfolio companies. We talk about Stephen's background. We talk about YMP, Young Mining Professionals, an organization that Stephen is very involved in. And we talk about the next generation of people coming into the mining industry and what success looks like for them and what they need to do to become entrepreneurs, to become professionals. This is a great podcast to listen to for anyone operating in the space, anyone looking at buying into early stage exploration companies. We cover a lot of material. So without further ado, let me please introduce Stephen Stewart from the OR Group. All right, Stephen, welcome to the Resource Insider Podcast today.
Jamie, thrilled to be here. It's been waiting for my invitation for a long time, so very, very happy to be here.
I feel like we've been talking about it for like a couple of years now, and I normally prefer to do these things in person, and I had thought we would get the day to do this in person when you were in Vancouver or when I was in Toronto, but a year into the pandemic, it doesn't look like that's going to be happening anytime soon, so we're going to have to settle for a Zoom call right now, and then maybe we'll have a round two down the road somewhere.
Here we go. Let's do it.
All right. Stephen Stewart, chairman of the OR Group. For people who don't know what that is and who you are, can you give us the 30,000-foot overview of who you are and what the OR Group is and what you guys are doing today?
Sure. The OR Group is it's really a collection of people who invest in the resource world, effectively. I mean, the street would label us a merchant bank, but I don't really like labels. As I said, it's just a representation of the group of people who are affiliated with us, and it culminates in a basket or a portfolio of junior companies, most of which are public, some of which are pre-public, en route to listing, etc. And we're in this to make a discovery. That's really, to me, fundamentally what the OR Group is all about, trying to make money for our shareholders by making a discovery.
Mm-hmm. And so, you know, this is kind of a common term within the mining space, a group, you know what I mean? We have sort of the discovery group and various other sort of affiliates. Can you know, I think it might be worth talking about very quickly for people, investors at home who maybe have heard this term thrown around but don't really understand how it works. You sort of mentioned a merchant bank. Can you sort of talk about why we see these groups form in the mining space and what sort of advantages they might offer to companies that are often, very small, sometimes underfunded, sometimes understaffed, how these sort of consolidated enterprises or groups can kind of lend a benefit there?
Sure. Well, there's a lot of reasons to have a group, and let's define a group by having multiple, call it publicly traded juniors. I can't necessarily speak to those other guys, but I imagine they're all created in the same vein. I can speak to my rationale is that I like to categorize companies within their commodities and their jurisdictions. So I don't like to have a nickel project mixed, in Manitoba mixed with a gold project in Quebec. Mm-hmm. So those two commodities have distinct audience groups, i.e. investors, oftentimes distinct technical expertise that is required to discover a nickel deposit vis-a-vis, a gold deposit, shear zone hosted deposit in the Abitibi. So that's broad strokes why you'd want to have two different companies. And of course, the OR Group has half a dozen companies. And you'll notice, for the most part, there's exceptions to the rule. And I guess OR Finders and Mustanga would be an exception to the rule there. But there's a very good explanation why those two are quite similar in their focus. But you'll see we've selected a basket of commodities, and it's gold, it's copper, it's uranium. We're getting into the nickel industry. And so it's really just us building a company around either a technical individual who's got a great track record, like James Sykes, for example, in uranium, and then getting him to go out there and acquire a basket of assets, or it happens the other way around. We identify an asset that is in a particular space, like the Opemiska and QC Copper, fantastic copper deposit. And then we look to install the right person for that particular project.
Okay, so why don't we talk a little bit quickly about the different companies in your portfolio now and what they're focused on and what each of them are doing?
Sure. So we've got Mustango River Resources, traded on the CSE under the symbol MIS, and I'll lump Ore Finders into the same category as it. Ore Finders is sort of I don't want to say the parent company, but was the original company, and it has exposure to perhaps not all of the companies in our group, but most of them. And the reason those two companies are both focused on gold. They're both focused on the Kirkland Lake camp by and large. Why we have two almost identical strategic focused companies is because Ore Finders did a hostile proxy battle on Mustango and took it over. I do think that those two companies probably, all else equal, belong under one roof, but we're not going to move forward with that sort of, call it, amalgamation until there's a real good reason for it. And there's, I won't get into the details, but it's a lot of work to amalgamate just for the sake of it. But the other company I mentioned is QC Copper. It's focused in Quebec, in the Chibougamau district, Chibougamau-Chapet. It's an old Falconbridge mine that we acquired. It's got a huge amount of data. We believe we've done an internal resource. It's got a very robust pit constrained model of both copper and gold. It's copper rich, and there's all sorts of exploration upside in that company. And it's QC Copper happens to own about 35% of another company we control called Baseload Energy. Baseload is a TSX Venture uranium exploration company. That was what I mentioned before. We built that company around James Sykes. James is a really brilliant young geologist who's really passionate about uranium. And I've been trying to get exposure to the uranium industry for a long time. I'm a big believer in the economics and of that metal and its actual fundamental utility. There's no better place to be than northern Saskatchewan. But I was just waiting for the right individual, because uranium is very niche in terms of how you look for it. It's very different from our typical group. And then we've got American Eagle Gold, which is a soon to be, but we're going to be listed in probably first week of April. We just completed the private placement. All that funds are held in escrow until listing. Will be on the venture. It's led by a friend of mine, Tony Moreau, who I've known for a long time, and it's focused in Nevada, in the Carlin Trend. It's got a couple assets there, and I think our shareholders can expect us to grow that portfolio as we become listed. And last but not least on the list is a company called D-Block, which is, again, pre-public. It's not as advanced stage as AEG or American Eagle in terms of listing, but we've got a CPC that we're going to be merging with, and we got a couple nickel assets, one in the Thompson Camp of Manitoba, which is a world-class nickel district, and then we've got a really exciting grassroots exploration project that, to me, is why I've started D-Block, is because I was approached by a couple of ex-Inco geologists who've spent the past 10 years trying to find the next nickel sulfide camp. They've identified something really interesting, and they came to me to finance it, and I acquired it. It's very binary. It's either they're right, and if they're right, it's going to be a huge hit, or we're wrong. And more oftentimes we're wrong in the exploration business. But we vetted this thesis, and we think it's worth the risk reward. So in the coming weeks, I think people, or at least will be talking more publicly about D-Block, raising the seed round, going public round, et cetera. But I think it's going to come together quite quickly. And that sort of rounds out the public facing companies that we have.
All right. So we've got copper, gold, uranium, and soon to be nickel as well.
You got it.
Okay. And is that 5 companies or 6?
Six. That'll be half a dozen companies. And I think that really rounds out the exposure that we want. We typically, those commodities to me, gold, I'm a gold bug. I believe in gold, the narrative behind gold, because of my personal beliefs on the macroeconomic situation, fiat currency. You've heard it before. We don't have to get into it, but I see serious macroeconomic issues on the horizon. If that doesn't happen, that's fine. But I think gold is good have a exposure to in that sort of situation. Whereas I'm a big believer in base metals because I also think they're going to be building infrastructure in order to catch up with the East, in particular China, who is really nipping at the heels of, call it, world domination. And so I think the West has no choice but to build roads as a bridge, airports, tunnels, etc. And then if you want to add the electrification aspect on top of that to juice it up, I think we're on the precipice of what do you call it? But a fundamental event that is really going to see money come from the oil and gas sector, trillions and trillions of dollars be diverted away from, call it, carbon producing, fossil fuel burning, electrical generating opportunities towards, call it, clean, green metals. And I think in order to maintain our way of life, we're going to need uranium to power. I think we're going to need copper to transport said power, and we're going to need nickel to store it. At least nickel in the mobile capacity to store it. Grid storage is a whole nother argument that I don't think we've solved that recipe yet. But those are the real fundamental commodities that I see having huge potential in the face of a massive infrastructure build.
That's interesting you mentioned that. So last week, I did a podcast with a gentleman named Owen Haggerty from EMR Capital, a big private equity firm out of Australia, and we were talking about sort of this shift. Shift is maybe not the best word, but it's kind of this amalgamation now of the mining space and the energy space, right? And you're kind of blurring the lines between what constitutes energy now, and metals are going to be taking up a lot of that role that was, previously held by oil and gas. And something we discussed, and that it sounds like you're touching on the same idea, is that do you think mining companies that are mining the coppers, the nickels, maybe the lithiums and cobalts, these sort of things of the world, are going to start getting, the ratings, the re-ratings and the cash flow into them that were traditionally associated with the energy sector, oil and gas?
Well, there's absolutely no question about it. The only question is timing. I don't think it's going to happen overnight, and we're not there yet. I do not think oil and gas is going away anytime soon. I think the transition is in progress, clearly, but it's going to take time. Oil and gas, you mentioned, they're cousin industries, right? Even though they're very much bifurcated, it's very rare to see guys like me involved in the oil and gas and vice versa. They stay apart, but at the end of the day, they're extractive industries. But I don't think, clearly we see that there is a policy being mandated for the public at large to get away from carbon, whether through carbon taxes and all that sort of narrative, and that's fine. I don't think the economics are quite there yet. Call it the free market economics. It's got some ways to go, and we can use, call it, the battery, the EV cars as a good proxy for the economics. Clearly, they're only. I'm not totally up to speed on the true numbers, but it's somewhere between probably 1% and 2% of cars sold are EVs. Now, clearly, it's a better product. You go faster, less moving parts, less maintenance. It's cleaner. There's I guess if you eliminate the fact that it's probably powered from a coal generation facility or a nuclear industry, it's supposedly zero output. But the fact is, they're just not selling. I mean, if it's 98% still dominated by internal combustion, the reason is simply economics. But that is changing quite quickly. I think the threshold has to be before they get down below the $100 per kilowatt storage in that car, and we're seeing huge changes. So I think we're almost there. We're not quite there. But when we do get there, it's gonna come quickly.
Yeah, I think people do overestimate the speed at which things move. I read an interesting study a few months ago that the transition from firewood to primarily coal, I guess it would have been in the 1800s, took about 100 years before coal actually outperformed, not outperformed, but was the primary source of fuel. So I don't think it'll take 100 years on this one. I think the world moves a little bit faster today, but it's not going to be 2 years or 5 years, I would suspect.
Yeah, I think the magic rule I've heard before. Again, this is just anecdotal, but once it hits 10%, then it's just it steamrolls and there's a huge tsunami of demand. So I think we're probably in the low single digits, getting our way to 10%. But once the adoption rate of EVs and similar type technologies come into play, that's when we're going to see the rapid decline of oil and gas in terms of transportation. Now, that doesn't mean oil and gas is going away. It just means that it has different uses. I mean, oil and gas is let's just go, gas or oil is used in our clothing and plastics. And, it's such a deeper industry than most people realize. Obviously, putting it in your car and in our planes and boats and whatnot is probably the largest component. But look, it's not going it's not going away, but it's definitely, there is a shift occurring, and it's real, and it's going to be, I think, that opportunity when it does come, when we do get to that 10% threshold, is going to be the biggest industrial opportunity since the Industrial Revolution. I really just think the whole world is going to be rebuilt in a sense.
Okay, good. Let's get back to mining now. So,
all right.
When we first met, I want to say this was probably somewhere around 2017-ish, and you were, I believe, correct me if I'm wrong on this, you were the CEO of Ore Finders at the time. Am I right on that?
I was CEO in 2017, and I still am, yes.
Okay. Sorry, I thought you'd stepped up to just chairman. I didn't understand.
No worries.
So you're CEO as well. Okay. I remember talking to you and reading or watching some of the material or interviews you'd been part of, and a big focus for you was on the strategy of acquiring ounces in the ground versus exploring for ounces in the ground. And can you talk a little bit on that strategy, why you came up with that, what it means to acquire versus explore, and sort of what you viewed as the value drive of that?
Yeah, absolutely. And it's that I didn't come up with it. I borrowed the idea. It's really, my whole thesis is based on cyclicality. The whole world is cyclical, down to the molecule. There's cycles, and that manifests itself certainly in markets, and mining is no exception. And so with that sort of fundamental view that this is a cyclical market, you try and be counter-cyclical in your strategy, not just for the sake of it, but you have to identify trends. And I back in, I guess, starting in 2015, we really stopped from the drill strategy, which Ore Finders was doing. And we evaluated the economics. I mean, so it's very easy to look at the numbers. And if it's costing you X dollars to discover, drill out a fresh ounce, meanwhile, you can buy said ounce or a sort of a duplicate of it. Meanwhile, all ounces are sort of like snowflakes, but if you could buy that same 43,101 ounce in the same jurisdiction for 10% of the cost, to me, that's a no-brainer. And so that was the strategy we deployed. In 2015, we just said to the market, look, we're not drilling, period, end of story. It was not necessarily popular with shareholders. If shareholder just heard me say that, they'd probably take a pass on it. However, if they took the time and asked me why, and explained exactly what I'm explaining to you today, is that the replacement costs far outweigh. So me buying that ounce that was drilled 5 years ago, 10 years ago is much better economics. You sit back, you acquire. Not only can you acquire in a distressed, call it broader macro scenario, you look for those unique opportunities within that. So, obviously gold price is down, and then you look for those companies that are struggling. And so you buy a distressed situation in a down market. What's fundamental to that thesis is you have to have the cash to hold on to it, right? Mm-hmm. You need to acquire title and have tenure on it for an undetermined amount of time. So you require cash, you require patience. And then when the market turns, that's when you look to expand organically, and you turn inward. And I think it was in December, go back to Ore Finders news release, December 30th, 2019. That's when we said, look, we are going to be shifting strategies. So we've been, pounding the drum, don't drill. And we quite correctly predicted, though we got lucky. I mean, we didn't know, but we just in our gut was saying things are changing.
Yeah.
And that's when we said, we're going to go back to the drill bit. But before we did that, we had to raise capital to do that. And so 2020 was a year where across our portfolio, I think we raised probably north of $35 $36 million within that portfolio, all with the aim of putting that money back into the ground.
Not just
so now
ore finders, across the whole ore group.
Across the whole portfolio, not just ore finders. So ore finders, Mustango, QC Copper, Baseload, American Eagle, all those companies were in capital raising mode so that we could go and put the money back into the ground so we can expand. So we bought 1 ounce for a cheap price, but we want to take that 1 ounce, turn it into 2 ounce, or, I should be talking millions because that's the real objective, but I'm just trying to make the point that with the, and back then I have to sort of build on top of 2015 through 2019, the cost of capital, which is a fancy word for saying my share price was so low that I didn't want to dilute. To put it into the ground, if we were going to, give away 10, 20, 30, 40, 50% of our company for a multi-million-dollar drill campaign, and then we meet investors' expectations, we get great intersections, but because the investor base just isn't there, we get sold off. Buy on rumor, sell on news sort of thing. So what sense does that make? It to us, it didn't.
Yeah. I want to break this down a little bit further for people at home who might not fully be sort of understand all the terminology that we're saying. So, when you're talking about the difference between the cost of drilling versus the cost of acquisition, people at home should know that it costs a lot of money to define an ounce of gold in the ground. You've got to hire the team. You've got to put a camp out there. You got to get out there. You got to drill the holes. You've got to recover the core. You got to assay the core. You've got to then hire someone to write up an NI 43-101 compliant resource. And a company, and I mean, especially an established exploration company like Ore Finders, I assume at this point has a pretty good idea of what it's going to cost for every ounce that you're able to add to your resources, right?
Certainly, we can look in the rearview mirror and make certain assessments of that. But on top of what you're discussing, is there actual risk of is it
well,
there?
Yeah, exactly. Even if it's and then the answer might be there's none. So to go out, you found that you could consistently find in that region, and I think we're talking about the Kirkland Lake region, right? In Ontario, one of the most established gold jurisdictions on the planet. And you were able to go out and from other, probably frankly distressed companies at that point that were out of cash, buy the ounces off their book, acquire projects for a price that you deemed cheaper than what you could actually accomplish.
Correct. Pennies on the dollar.
So
pennies on the dollar.
How many ounces did you acquire during this phase of your growth? What did you guys get up to?
Well, collectively, probably close to 2 million across the portfolio. I mean, I can give you one example, how we made an acquisition, which was really not something that I would recommend, but it's something that we went through and learned a lot from was our Mustango situation. Mustango has about 600,000 ounces on the Cadillac Fault, as well as a land position right beside Macassa. When we took interest in that company, I forget the exact date, but it had a market cap of $1 million.
Mm-hmm.
Okay, $1 million. It had no cash. It had terrible balance sheet. It was an awful mess, corporately speaking. But it had this asset, had this land package.
Right. So it's less than $1.60 an ounce, something like that, or less than that.
Yeah,
$1.40 an ounce.
Just really pennies on the dollar in terms of what this would trade for now and what it does trade for now. And we acquired our position for $250,000 worth of Ore Finders shares, which we've parlayed into, which at the time was 31%. It's been diluted down, but still worth. I mean, that from an investment standpoint, from Ore Finders position, we really hit it out of the park. And then alongside that, I became a big shareholder in Mustango and did very well on that acquisition. But really, that was about identifying it was a bad time. Macro speaking, nobody was interested in investing in that company. As I said, we and that was a distressed situation. And when we resolved that distressed situation, we went through a year's worth of court battles, et cetera, and then we tried to finance it. I think we tried to finance it at 2 or 3 cents. Nobody wanted to write that check, So I mean, right. Even with those economics, even with a new team in there, it just speaks volumes that nobody wanted to write checks at the 2 and 3 cent range.
And what is it at now?
We got it done. What's that?
What are you guys trading at now?
I think we're trading at 12, 13 cents, but we pulled back substantially. I mean, we hit a high of 35, and I think the market's softened for the juniors, and people are waiting on our drill results. We've got a big drill campaign that's going out, but there was a time when that was a 10 bagger easily. Now it's only a 4 or 5 bagger, but I expect our drill results, and we've got a lot of news forthcoming that stock has a lot of promise in it. It's got a lot of cash too. It's got about $6.5 million of cash.
So come 2019, you guys decide, all right, time to put the acquisition strategy on hold, time to start drilling, time to start exploring the portfolio that we've built. What were the things you were seeing that prompted that shift?
I don't know if there was any one particular thing. It's really just a collection of experiences. I'd have to go back and put myself in my shoes of 2019. I suppose really it's the interest in gold price. I think gold had then just come above $1,400. I mean, people can go and double check my facts, but there became a heartbeat in the gold industry. Now, of course, we'd probably be crying in our cereal if gold was down, back at 1,400. But at the time, it was big news, and it was just sort of, I think when it got above the 1350, it was really when it broke a long, I think 6-year support. And so that was just one indicator, but really it was just anecdotal. It was about people like me, my colleagues, trading assets, getting calls, unsolicited calls from investors to me. So it was just a collection of anecdotal facts like that, paired with an increase in the gold price, which led us to believe, okay, we think we're going to be able to get our share price up. And I think the market's going to be ready for some drill campaigns again, because I have the very firm belief that this whole industry over the past, and this is not just specific to gold, but the whole industry has been depleting their reserves without replenishing it. And we're not finding it like we used to. So these reserves are dwindling. They're harder to find. When we do find them, they're much lesser grade and they're deeper, or they got metallurgical issues, or they're in crazy jurisdictions. So I do think that established resources are going to be even more valuable, very, very valuable in the years ahead. I think we're at the beginning of a real strong bull market. And that's fundamentally based on the demand for commodities that we're going to need to maintain our way of life, whether that's the base metals or to hedge against this monetary craziness, this fiat craziness, which seems to be going around, and potentially inflation down the road.
You mentioned crazy jurisdictions, and that's one of the questions I wanted to ask you about. You guys are in Quebec, you're in Ontario, you're in the Athabasca, you're in Nevada now. These are tier one mining jurisdictions, established mining jurisdictions, long histories of mining in all these places. Was this a very conscious choice on your behalf to stick in sort of what I would call the tier one safe jurisdictions against going to maybe these more frontier markets where perhaps there's less geological at risk, but much more political risk and instability risk and all these sort of things?
Yeah, well, you hit the nail on the head. It's all about risk and one's ability to manage risk, and how you position yourself and inform your shareholder to be prepared for what type of risk. I would love to be in some of these, call it lesser tiered or jurisdictionally risky jurisdictions. Just call it, like, Africa's a big place, but Africa is just generally viewed as a riskier place. There are elephants yet to be deposited. To your point, there's geologically, there may be, I don't know if it's less risk, but there's certainly more deposits to be found than in the Abitibi, which has been poured over. But from my perspective, it comes down to people and experience. I'm well positioned to understand the geologic risks, but also jurisdictional risks in Canada and the United States, because that's where my experience lies. That's where my team experience lies. If I had a partner who grew up in the DRC or Botswana or Indonesia, for that matter, I would feel more comfortable going into that jurisdiction, but not without their expertise of the laws, the language, the culture, the people. So the reason is not because I'm necessarily against those jurisdictions, or I think that you cannot do business there. You absolutely can. Clearly, it's been proven time and time again. It's just not where my area of expertise is. So why would I leave my area of expertise when I can do business in my backyard? And I know very well that there are world-class discoveries yet to be found in a place that I'm very comfortable doing business with.
Yeah. Have you ever, taken a hard look or a serious consideration of an asset in a place in Africa, in Latin America, in one of these potentially more challenging jurisdictions?
Absolutely. I've been invested in and hasn't worked out. And so I haven't had great experiences as a primary, call it an operator, and I haven't had great experiences as an investor. But as an investor, probably less seasoned, because I typically invest where I know, and that's, I invest in people who are companies that are focused in safer jurisdictions. So I guess I do have a natural bent towards investing in these safer places, because I think this business is risky enough. And from a geological perspective, I think a lot of these, call it riskier jurisdictions, they're a phone call away from losing their deposit, and that really concerns me. That said, let's define what a tier one, jurisdiction is. There's no question that in Canada and the United States, we face a whole lot of jurisdictional risk. Just because we are quote unquote, civilized, that doesn't mean that things don't change very, very quickly with the political regime du jour. Certainly in Canada, just ask the oil and gas industry out in Alberta how they feel about, jurisdiction, or the pipeline companies. And I think, it's yet to be seen about how the Biden administration is going to really operate in the U.S., specifically to mining. But I think people are quite concerned down there. So that begs the question, what is jurisdictional risk, and is there really a safe place? And the answer is no. But it comes back to, again, your original point is risk, and understanding those risks, communicating them to your investors, and being comfortable with it yourself.
Yeah, it's a hard equation to crack these days. I've seen lots of companies run into just as many challenges with First Nations and Indigenous issues on projects here in British Columbia, as I've seen companies in Peru with local community issues. And, often the result is the exact same, barricades or blockades rather of projects, and really just complete gridlock of any progress being able to be made, because companies haven't managed the political or community or Indigenous issues adequately. And, this is something we consider a lot at Resource Insider. We think about a lot before we get into a jurisdiction, before we invest in a company. We've gotten it very right a few times, and we've gotten it very wrong a few times as well. Namely, in Africa, we've been involved in projects where employees have been murdered on site due to challenges, and it's a part of this business that a lot of people sitting at home don't fully appreciate. Often the risks being taken by these geologists or guys working on site or drillers or what have you to work in these parts of the world.
Yeah, no, when you get into the question of call it employee safety, that's a whole nother consideration. That's something that to me would be a non-starter for me personally. I fully understand that there's all sorts of phenomenal deposits that companies go and are willing to endeavor, and hopefully they provide the security. But for me, that's not for me. The riskiest thing I take on is something that, expropriation.
Yeah.
But yeah, look, it's you can't find these deposits don't occur outside of downtown Vancouver.
I know. But so many, and the issue with a lot of these sort of emerging jurisdictions is things change very quickly. An area that was safe one month might not be the next month. And it's, it's part of what makes mining a very interesting business, but also a very challenging business. Okay.
Yeah, it's dynamic for sure.
Let's take a step back, Stephen. And talk for a second about how you actually ended up getting into the mining industry, because you come from a primarily business background. Am I right on that?
That's correct. I guess, I'm traditionally, I'm educated in the finance side of things, but I had exposure to the mining industry. Well, primarily because I'm from Toronto, and Toronto, much like Vancouver, is really a hub. We like to say we're the financial hub of the mining world. I don't know if that's true anymore, but Vancouver certainly would give us a run for our money. But these are hubs, and they're centers for people, geologists, lawyers, financiers, entrepreneurs, people like me. We live here, and I believe in proximity. So if you're proximate to somebody, you're more likely to be friends with them. So if you're proximate to an industry hub, you're more likely to be associated with that. And I suppose that to take that to the next level, my father is a mining lawyer. And so I had exposure to this industry through him, and I still work with him. But that's how I first got exposure to it. And so from a very young age, while I wasn't necessarily working on it, I was aware of it. Now, had I grew up in Albuquerque or wherever, less so. I may have had interests elsewhere, but it's really about proximity, exposure, and then eventually I just got hooked.
Yeah. That's a good point. And it's not something I've talked about on the podcast before. We've got a lot of, I guess, young professionals who listen to this podcast, and I get questions a lot from them. So I'm from Toronto as well. And I
didn't know that. I didn't know you're from Toronto. I thought you were a Vancouver guy. I know you live there now.
Well, I'm actually from Kingston, Ontario. And then I went to U of T, and I lived in Toronto. I worked in Toronto for about 10 years for Hatch Consulting and a variety of other sort of businesses there. And, I always kind of picture Toronto as like, if we think about New York as the finance center, I think of like Toronto as the finance center for the bigger, more established companies. And I think of Vancouver as more approximate to like a Silicon Valley for mining, where so many of these companies get originated and started, and there's really a great venture scene. But as companies tend to progress and mature and grow, they often end up in Toronto where they need access to bigger sources of capital and banking and all the rest. But I liked your sort of comment on sort of how the sort of being in a hub for something like this, because I get a lot of calls and emails from young geologists and engineers and whatnot who say, look, I've worked at this mine, or I've been involved in this project, and I'm really interested in getting involved in the business side of things, or I'd like to start a junior company, or that any number of things like that. And I actually always say, and it's not always well received, is you need to get yourself to Toronto or Vancouver if you want to do this. It's really, really hard if you're not in one of these locations, at least when you're starting out. When you're more established and you've got a reputation and had success, it gets a little easier and you get a little more flexibility. But I can probably attribute the vast majority of sort of my success, and especially in this sort of startup mining space, of being in Vancouver. And I don't think I would have ever come to it or been able to achieve it had I not moved here. And, it's just so important to be around, especially when you're starting out, just be around the things that are happening. And it's harder to do that in Timmins or in Sudbury or, any of these other places where there's certainly lots of opportunities to work in mining. But if you want to sort of invest and start companies and be involved in startup companies, you have to be in one of these hubs, or else you're at a serious disadvantage, I would say.
No question. I like your analogy of Vancouver being Silicon Valley, and I think that's fair to say. And Toronto's by and large home to the bigger guys, though there are quite a few juniors here. Mm-hmm. But you're absolutely right. I mean, what we do, they don't teach in school. So there's only one way to do it, unless you're sort of gifted or profoundly talented. You really need to work for somebody who's done it before. So, go bug Ross Beatty, go bug Mark O'Day, or, guys like that, Rob Friedland. If you can get in the door there, that's the best way to do it. Now, I mean, that's if you want to take a fast track and become the entrepreneur. The other way, of course, is become an engineer, become a geologist, learn the trade, the technical side of it. And then eventually transition to call it the deal side.
Mm-hmm. But that's not an easy transition to make. And I know a lot of engineers and a lot of sort of geologists that are trying or have tried to make that transition, and not always successfully. And I would say the only reason I was able to do it is because I came here and I worked for a lot less money than I was been previously getting paid.
Well, I don't think it's money, Jamie. I think it's because you persevered and you sort of, you inserted yourself into a situation. I think you worked with Greg Smith, mm-hmm. and others, I imagine, and who've been very successful. So you did exactly what I was talking about.
Yeah,
you found somebody who knows what they're doing, and you hitched your horse and you learned. I think it's certainly. Let me repeat, it is very difficult to do what we do. There's a lot of moving parts. I think your odds of success of doing what I do, for example, are much better if you're a geologist or an engineer, because you've got this fundamental technical basis. While I'm not classically trained, I probably have the equivalent of a BA in geology, because I know, at least I know how to ask the right questions. Mm-hmm. Okay. So, and I know where to push, but I think And the reason why I say they'd be best served in going to work for somebody else is because you really want to learn all facets of the business. You can't just be an engineer or geologist. You have to be the lawyer. You have to be the promoter, the marketer, the IR, the CFO, compliance. All of these things have to come together. You have to sweep the floors, really. I mean, if you want to be a successful leader of any business, you need to understand every single facet of it. You can't be an expert in all these things, but you need to be able to question and push back on these so-called experts so that you're not getting taken, because you're going to be, and not in a negative way, people aren't trying to take you, but you will be taken if you're not paying attention and you don't know where your weak points are. So it's I don't want to say it's impossible. Nothing's impossible, but your odds are greatly improved at success in starting a company if you can call it apprentice. Let's just call it that.
Yeah, I think that's the right way to look at it. And, the challenge is there's no book for it, right? There's nothing you can, I often get asked that, where should I read? What should I read to learn more about this? And I always actually recommend read The Big Score, the story about Robert Friedland.
That's the gold standard, isn't it? That's one of them, that's for sure.
I think that, to my knowledge, gives the best sort of overview of how the industry works and the different players. You've got the brokers, you've got the promoters and the geologists and the major company executives. And, I read that book in university when I was like 18, I guess. And I remember thinking, like, well, that seems way cooler than being an engineer. Like, I should go.
You want to bang your shoe on the table, right?
But it's true, but you got to be in one of these places. These things are happening, and learn from the people that are doing it. And most of them learned from somebody else that was doing it too. And I think apprenticeship is a very good description of that. And that leads me exactly where I wanted it to our next question. Which I want to talk about something you've been very involved in, and I've also been more peripherally involved in, which is YMP, the group Young Mining Professionals. Why don't you give us the overview of what YMP is?
YMP is just a group of young people who are interested in networking and developing business opportunities. I mean, to me, that's the essence of the group. It's evolved into quite a more sophisticated organization than that. But ultimately, its aim is to promote the industry, promote young people within it, foster relationships, because you're only really as good as your network. I always view life as just nothing but a series of obstacles and challenges that lay ahead of you, and how one solves those problems is really tantamount to how successful they are in life and in business. And if you want to be a good problem solver, you're going to need a network. You're going to need to call on people to assist, whether that's delegate within your team or call on somebody for a favor or call on somebody for expertise. The origins of YMP is in your hometown, of course, your new hometown of Vancouver. It was started, I think, about 12 years ago by Greg Smith, and two other guys, and it was a great idea. And it was really just, I would say, a supper club, if you will, where they would get together with their buddies and they would have a steak dinner.
I think I would have called it a drinking club, but I think that's a more generous way to describe it.
I wasn't trying to disparage those guys, but yeah, I'm sure it was some booze were involved, and they are involved here. But that's not what the group is about now, and I don't think it was there. It's really about, again, getting like-minded people together, and so that's what it was. And I think.
Yeah, well, it was a bunch of KPMG accountants, I believe, that wanted to meet executives in the industry, and they threw these sort of,
they wanted to generate tax and audit business.
Yeah, four meetings a year where they'd rent out a room in a restaurant. They'd bring some executive. He'd kind of share his life story and what he'd learned, and et cetera along the way, and gave them access to new business, but also they learned a ton about what was going on in the space, and it really evolved here to being a proper club, and then it was full of lawyers and engineers and geologists and anyone interested in the business. And then I think you were instrumental in you opened the Toronto chapter. Is that right? Am I remembering that correctly?
So when I found out about it, I had been in the industry for a while, but all my associates were gray hairs, and I don't think the community here in Toronto isn't as deep as it is in Vancouver. So I really didn't know a lot of my contemporaries or people younger than me. So when I found out about the group, I thought that was great. I'd love to go to an event, and I found I was only in Vancouver. And so I figured, okay, well, I'll call these guys and say, hey, bring it to Toronto. And I think those three guys had sort of that group had sort of reached its a point where it needed new leadership, new legs. As I said, it's probably 10 years old.
They weren't that young anymore. Actually, most of them were much more established in their career and focused on other things and had families and all the rest, right?
Well, there you go. And it's true, families. And so make no mistake about it, it's been a big time commitment, but a very valuable one that I've made. So I just made the pitch, let's bring this to Toronto. And then from there, I just sort of got my hands on it and have been, for lack of a better term, operating the group by and large ever since. And when I say the group, I mean certainly YMP Toronto, but it's grown into a global organization with a global board. I serve as its chairman of the global group, and we have expanded to all 6 continents.
And that's what I wanted to bring up, because there's probably a lot of people listening to this who would be interested in this, but maybe haven't heard of it. And so what are some of the cities you guys are operating in now?
So we've got a chapter in South America. It's YMP Peru. We've got soon to be announced, but I'll put the cat out of the bag. We've got YMP Mongolia. We're just about to announce with a really exceptional group of young people who work at Oyu Tolgoi. Very sophisticated and group of engineers. Great ideas. I was blown away about how sophisticated these guys were out of Mongolia. We've got a chapter in Johannesburg. We've got 3 chapters in Australia. And then, of course, in Europe, we've got the UK, YMP London, and in Vancouver, Sudbury, Montreal, and Toronto. So that rounds out the family, and they're all not-for-profit organizations, all not-for-profit. So everybody is a volunteer, and we've evolved it to the next level. We've started something about 3 or 4 years ago. We started the charity arm, which is
right. You have a scholarship now, right? Is that right?
Correct. It's the YMP Young Mining Professionals Scholarship Fund, which is run out of here in Toronto. And I think this year we're just about to announce our scholarship program, and it's going to be north of $90,000 this year.
That gets allocated to different candidates and
correct. Yeah. Not to one person. That'd be
a great deal.
Amazing scholarship. But no, there are, let's just say, a dozen scholarships, each partnered with corporate sponsors: Barrick, Agnico, Yamana, Kinross. I don't want to name them all, but I don't want to leave them all out. But fantastic partners who we approach, or they approach us now actually, and they say, look, we want to be a part of it, and we facilitate everything. So they give us the money, we market it, we identify the candidates, we shortlist it, we manage it. I mean, it's quite a process to market, solicit, and select. And so we do all that. We do all the heavy lifting for the partners. And then the objective is simply to give away their money to the students. And the most proud thing I am about that is that literally 100%. So every dollar that we get from Kinross or Barrick or from B2 Gold or from Equinox, and Greg is a great help and brought that new sponsorship to the table, that goes directly to students. So there's no administration fees, no nothing. So all money flows directly to students.
And is this tax deductible for the companies?
You bet.
All right.
They make money.
So companies listening out there, great charity, great cause, helping develop the industry, tax deductible. Where can they find out more about this, Stephen?
Go to youngminingprofessionals.com and click on the charity aspect, or get in contact with me. Go to theorggroup.ca. You'll find my contacts there. We'll be more than happy to grow our scholarship fund. That's our objective. Really, that's where I focus most of my time now, is growing that endowment so we can attract young people, because there's such a huge talent gap in this industry, which is exacerbated by the boom and bust nature of it. When there's going back a year ago, I would have said, look, there's no jobs for the past 5-6 years for somebody coming out of the U of T program, which, by the way, you graduated from the Lassonde School, or what is now known as the Lassonde School.
That's right. Yeah, it was the Lassonde School when I was there.
So that's just up the street for me. And every year I go and I give a lecture there to the graduating classes, the capstone class. It's been a lot of fun. And, the last 2 or 3 years has been 5 or 6 people in the graduating class.
Yeah. So when I was there, we were a big year. So we were 30 people, but the year before had been 9, I think. And I think that just goes to show how cyclical it is.
Absolutely. But I suspect that, in a year or two,
five. Jeez.
5. That was last year. Actually, I should say, I don't know this year because I did this year's online, so I never got to see them. But the year prior to that, there was only 5 people in that graduate class because there were no jobs. And so why would you spend, 10 grand a year, whatever it is, tuition, all that, accumulate that debt to come out and basically go work for Rogers Cable because there's no jobs in mining.
So, are you finding companies now are demanding young talent? Are the companies out there, have those jobs come back? We've seen the industry pick up massively over the last year in particular. Do the sort of the bigger companies, the places where, I think as a young engineer are the best places to work. I worked at Hatch Consulting and Leighton Contractors, but in Toronto, there's Barracks, for example. Kinross hired a lot of my classmates. Are those guys, have you seen starting to look for students now? Are those, what do we call them? EIT, like engineer and training programs. Have they come back?
EITs, GITs, yeah. But I don't know if they're demanding, them per se, but it's a supply and demand situation. It's really, they're demanding people. And so I think all the experienced people are being taken up. And so they just, have to go down into the earlier talent pool, if you will. That's just sort of kind of how it works. So I don't think anybody is out to get a GIT, but they'll take a GIT if there's no better alternative available. And right now, as you well know, the whole industry is flush with cash, for better or worse, for better, actually. But what that does is that creates backlogs of demand. So, you want to get an assay done. I was just on the phone with the CEO of an assay lab. Some of the labs are 6-7 months delayed. I'm trying to get a drill in Quebec. I can get a drill. I want to get a third drill out in a project. I can get the drill. I just can't get drillers. So as we have ramped up relatively quickly, especially in a COVID time, where, in some industries, in fact, the guy from the lab was saying, the government's giving away $2,500 a month. He can't get, labor because they'd rather stay home. So, we're still facing some of that stuff. So when you layer on the fact that we're doing drilling a lot of meters these days, and we need a lot of boots on the ground, compounded with the COVID issue, there's a serious shortage of talent and supplies. And I think, inevitably that's going to lead to cost creep, and the cycle continues.
Okay, so we're coming up on an hour here, and I actually have tons of other questions, which maybe we'll have to get to some of them in a round 2. But I do want to ask some sort of quick questions at the end. Sure. They don't have to be super quick answers, but I'd love to get your thoughts on them. Do you have any advice for sort of budding professionals, engineers out there? Sorry, I didn't mean to say engineers, words on my brain. Would-be entrepreneurs out there that want to take the step into, and we've talked a bit about this, but into a business career, an entrepreneurial career in this space. So, obviously we've talked about, join YMP, try to locate yourselves in places like Vancouver or Toronto where there's a mining hub. Is there anything else you would say that you should be doing if you want to start your first company, that sort of thing?
Take risks, be bold. Fortune favors the bold. Say yes. Don't say no. There will be a point in your career where you'll be forced to learn how to say no, which can be difficult. But until you've made it, say yes. Especially if you're young, you can afford to fail. And failure is really just a matter of attitude. You're going to fail, period, end of story. It's about how you deal with the failure, move on, learn from it, try not to make the same mistake twice. So when you are young, and I just had I just was called the other day about a guy looking to make a transition, and he's 31 years old, very seasoned, an investment banker, analyst. And I said, look, and he didn't know whether you go to A or B. And I said, take the bigger risk. You're 31, you're not married, you have no kids, you can afford to fail. And, that lesson in failure, if it is failure, in fact, probably will serve you well down the road. So be bold.
And if I could add to that, I would say something that comes to mind is get comfortable quickly asking for money. I think that's the biggest hurdle for especially like accountants and engineers and people from a very geologist, a traditional background, not sort of an entrepreneurial past, is getting out there and getting comfortable asking for financing and pitching your deal. It depending on your personality, it can be a very big hurdle to overcome, but that is one of the most, maybe the most essential skill set for an entrepreneur in this space. Yeah.
You got to ask for their business, ask for the sale. It's very difficult to do, especially if you don't have a track record. If you have a track record, it becomes substantially easier, but it's never easy. We are salespeople. Everybody's a salesperson at the end of the day, but you're absolutely right. People are skittish around asking for money because they feel that it's their reputation. But that's what I said: be bold, put yourself out there.
Yeah, and the quicker you can really build up a constituency of supporters that believe in what you're doing and are comfortable writing checks into the companies you're trying to build, the easier life will get. People want to keep learning about this sector. I know I said earlier there are no books to read, and it's a hard thing to do. But do you have any advice on how you can keep learning, how you can sort of develop skill sets, books, meeting people, conferences, anything like that?
Yeah, well, look, I devour as much information as I can get. I do not watch TV by and large. I don't make a point of it, but I don't watch TV. I stay away from the mainstream media. I consume information that's relevant to my industry and my businesses. And so that's just my focus. So outside of my family, which is my most important priority by a long shot, I make it a priority to learn as much as I possibly can about all facets. And that is absolutely books. That's where I start. I probably read every mining book, textbook, biography I can get my hands on. I got a whole bunch of it back there, but there's always new ones coming out. I've got them on order from Amazon. So books are your best friends. That's you putting the knowledge of 10,000 people into your head and experience. So I don't think anything beats a book. The other thing I do is I devour information on YouTube. So I don't watch TV, but I watch a ton of YouTube. They're like my lullabies. I find it, a biography at night or a documentary, and I just sort of put the iPad there and I never make it to the end, but that's just I assume I'm absorbing it as I sleep through osmosis, which isn't the case. But it's really just I'm just totally committed and focused on reading information that's relevant to my career. So I think and other media as well, and podcasts. I got to say, your podcasts I've listened to for how long you've been doing it. That's how long I've been listening to it.
Yeah, 2018. I think we launched early 2018. Mm-hmm.
Well, there you go. I mean, you were one of the first podcasts I started to listen to, and I sort of, got exposed to that medium, and I've been devouring ever since. I've probably taken a little bit of a break just because I've been, inundated with other things, but I love that medium when I'm walking. So I'm not wasting my time walking from A to B. Not that I waste time walking, but like I'm consuming information. So that I think that's critical.
Okay. Is there any advice you constantly hear given to people that you actually think is bad advice or wrong? So I'll give you an example. I think I often hear people say things like, oh, if I just I want to start a company, I want to do this, I want to do that. If I just complete this, or if you just complete that, I think my personal opinion is the better end. When posed with the question of when, now is always pretty much the right answer, and that it doesn't really get easier as you get older. It doesn't get more simple if you get more experience. So that's something I often hear people say, well, wait till you do this, or wait till you've accomplished that. If your goal is to start a company, start a company. That's my goal, or that's my view on that. Anything to add?
I would agree with that. Now carpe diem, as they say, just do it. Don't be afraid to fail. What I would say is, don't follow your passion. I think I can't remember who said it, but this quote always stuck with me: is that you're passionate about this. So I was passionate about pitching for the Jays, and I was a pretty good pitcher, but no matter how passionate I was never going to make the team. So my advice would be to find something that you're good at. Okay, because everybody's got a specific skill set. Either you're good at finance, you're good at rocks, you're good at this. Find something that you're good at and you can tolerate it, and then set the goal to become the best at it. Okay. You may not be passionate about it, but I think in time, passion can be developed. So I think passion can often mislead people. I think it's just developing your skill set that you have an inclination and an inherent talent for.
Yeah.
Try to become the best and try to make it a business. I think even if you're the best street sweeper in the world, you can make a business out of it and grow it. And so,
yeah, I think that's good advice.
I think it's focus and be good at one particular thing.
I think of often all the really, really successful people I know. I wouldn't say their defining quality is passion. I would say it's obsession. Passion is like being in your bliss. Obsession can be both good and bad, but almost all of them are obsessed to the point of, to a problematic point about their career and what they're doing. And those are, the most successful people I've ever seen. Whether that's good or bad,
in order to be successful, you need determination, which can be sort of, a proxy for obsession. Yeah, but you need to work harder than the next guy. I'm not smarter than the next guy. I think I'm smart enough. I probably just work as hard as anybody, and so I think it's hard work and focus and dedication are the keys. You can be passionate about when you're wealthy. That's when you can explore your passions.
Yeah, collect horses or something. All right.
Sure, having fun like that.
Stephen, thank you very much for your time today. If people want to know more about yourself and the OR Group, where do they go?
Go to orgroup.ca. My email will be there somewhere. Phone's there. I answer all my emails, my telephone calls, if I can, and I do. So I'm happy to talk to anybody.
All right. Ladies and gentlemen, thank you very much for watching. That is Stephen Stewart from the OR Group, and we'll be in touch soon. Thanks again, Stephen.
Thanks, Jimmy. Appreciate it.
All right. Recording done. Awesome. Thanks.